No.
Perfect. We are now recording. Yeah, so the company I want to look at today, I think Facebook is a nice, easy one that everyone may be familiar with, and I think there's some interesting things going on. I think the other thing, just like Liang pointed out, right, with these tech companies selling off so much, it's creating opportunities. So let me open up my Google Chrome, and then we can kind of get started. Perfect. So the fin it is. I'm going to share my screen. Raz, I'm going to make you co-host. If somebody comes into the room, you can just handle letting them in as I'm doing this.
Perfect.
All right, your thing keeps moving up and down on this thing. All right, make co-host. Perfect. All right, so let's just take a quick look at Facebook's valuations. All right, so this is maybe a 3-year weekly chart on Facebook, right? So this is Facebook from the pandemic lows. It was down to 140, went as high as 380. It's been selling off, right? And it pulled in all the way to 300 and back up to almost 340 again. It's actually a really good sign, right? Where other companies are selling off really bad, really quality companies are being bought right back up. So pay attention to that, right? That's a sign that that's a really quality company, and you kind of want to like just make that mental note for the next time things sell off, right? What company is going to bounce back quick? So right, Facebook has a PE of 23. So that I was like, compared to other technology companies that might have like 100 PE, 200 PE, we could pull up some other ones. Actually, let's go to their thing. Let's go to yeah, so there's this is like the communication services sector. And you're seeing, right, some of these companies have PEs as high as like 1,400, 200, 80, 70, 60. So Facebook trading at a PE of 23 is actually, pretty decent. Let's look at their growth metrics. Price to earnings to growth 1.12. Okay, so they have a PE of 23, and their earnings is expected to grow at 21% a year for the next 5 years. So maybe we want to see Facebook outperforming that. But I want to say, right, these are estimates made by Wall Street and stuff like that. And don't be surprised with the advent of the metaverse and Facebook kind of being an infrastructure play for the metaverse because they sell the Oculus. I wouldn't be surprised if they're kind of undershooting their growth rate for the next 5 years. So that's my 2 cents. Okay, Facebook has an operating margin of 41%. They have a profit margin of 35%, so that's always good. They do not pay a dividend. They do have cash. So you see these things, quick ratio and current ratio, that pretty much tells you for every dollar in debt, how much does this person have in cash? So they technically have $4.20 for every dollar in debt that they may have. So this looks good. They're cash rich, they're profitable, they have free cash flows because they have a profitable operating margin. And yeah, all right. So now let's take it the next step. Take a look at their website. So every company has an investor relations section. Let me see, how do I move this thing? And maybe the main website is meta.com now. Cool, right? So you'll go to a company's website, right? And how do we find the investors relations section. Usually you can find it like up top here, but it's not, or you can find it at the bottom of the website. I gotta sneeze. Okay, no, I don't. So you see they have this section right here for investors. So that's something you want to make note of. Any company that you're looking to invest in should definitely know how to find the investors relations section. If somebody just wants to make note of that. So we'll come here. Now there's two types of documents if you guys just want to write this down. There is the 10K, which is the annual report, and that's the SEC filing, right? All publicly traded companies must file a Form 10K with the SEC, outlining, everything that happened in that company for the previous year. And then you have the quarterly releases, which is called a 10Q, and every publicly traded company has to release that as well. So let's start with the annual report. I want to say there is the annual meeting report, and then there's the 10K. The annual report is sometimes, or the annual meeting report is a little bit different. I feel like, you know what, rather than talking about it, let me just show you guys. I think that'll just be better. You'll see the difference. Right, let's just go to SEC filing. This is strange. Okay. PDF. All right, so this is a pretty huge document, 129 pages. Some companies sometimes have an annual report that's 500 pages, 1,000 pages, 1,500 pages. And you guys don't need to read every single thing, right? So I want to say the first thing you want to identify is what are the key areas that you want to be reading. So this is an important thing to note. So I want to say unrelated to foreign companies, which their annual report is called a 20F, right? For the most part, this is the structured format of any annual report filing that's filed with the SEC, right? So the first thing you have is the business overview. So you want to read that section. You want to read the risk factors. Depending on the type of company, properties might be very important. Legal proceedings as well could be important if the company is like under any kind of like legal issues or whatever, but it looks like this section is only 2 pages, so maybe there's not too much going on, but we're pretty well aware of what Facebook has going on legally with their public legal battles. Then you want to look at, this is one of the most important parts, selected financial data, management's discussion and analysis of financial conditions and results of operations. So it's literally management telling you what happened in the year and why. And that's like one of the most important things. Financial statements and supplementary data. So you're going to find your income statement, balance sheet, statement of cash flows, all in this section. And then there's these other sections, right? Like executive compensation and things like that. And not to say that this isn't important, but it's not as mission critical as some of these first parts. And I want to say, right, when you're researching a company, you want to be efficient with time, right? So if you could just come here and maybe first read the business, read about the business so you fully understand what's going on. Maybe come and check out management's discussion to see, what they had to say. If they're looking at financial statements, before you read anything else and spend time on it, if the company isn't intriguing you or looking like a very interesting opportunity from reading those first few sections, don't even waste any additional time on it. Just because, you guys got to put yourself in perspective of, you might go through 30 to 50 companies before finding one that's really good, if you're a thorough researcher, right? So just how you're spending your time researching is very important. And, you could go and read everything about every company and that'll take you forever, or you can just kind of be efficient. Like I just pointed out, identify key sections that are relevant to you to read. And then if the company checks out in those sections, then you can go ahead and read further. So before I continue on this topic, anybody have any questions or thoughts just on what I just discussed right here?
Yeah, I have a question for you, Jeff. And let me get on camera actually too. My apologies, I was eating lunch.
You're
But
good.
yeah, so my question for you is, it sounded like you were saying find a company that interests you, right? So
Yeah.
kind of a more subjective approach with your investment strategy. But what if somebody has an investment strategy where it's pretty much I'm looking for a company with a PE above, I don't know, let's say 20%, but the company itself doesn't intrigue them? Should you follow kind of your emotions in that sense, or should you just stick to your strategy?
That is a great question. And maybe before I answer that, maybe I should just do a little walkthrough on different methodologies for idea generation, right? Because you're right. You can go and say, hey, there is a specific area that is of interest to me, or there's an area where I have domain knowledge, so I can identify winners better. But then there's also the methods like you're just talking about, where you're just like, hey, I'm looking for companies that are growing at 30% a year, 50% a year plus, and I just want the best in class as it relates to that. So just in terms of research methodology, that's when we want to take a few minutes to talk about that. I know that's sidestepping from the topic today, but I think it's important. The first thing is, yes, you can go and research and identify companies that you know and understand, right? But then you can come here and I want to say not next week because we have the holidays, but when we come back from the holiday break, we're gonna talk about how to use a stock screener and stuff like that. But yeah, you can literally come here. You can say, I want technology companies, right? You go and pick your sector. If you want a particular industry, you could pick that, but let's not even pick an industry. I want technology companies that are, let's click all, let's see, that's maybe expected to grow more than 25% next year in terms of earnings growth. Let's maybe say that has a PE under 50. And then you can just take the approach of, okay, now I've generated all these companies, and then you literally have to go through them one by one and then pick which one you think is best. So that's one approach, right? Using a stock screener to just generate random ideas based off of a thesis of some sort. Just like you said, you got to kind of just say like what your metrics are going to be, and then you're going to have a basket of companies, and you just got to go through them one by one and see what's best. And then another thing that you can do too is literally just like go through the news, right? Like, let's see, what's a good website that has sometimes just some interesting news on companies. Let's see. Like, you can just go through the news and go through headlines and see if there's anything interesting about just anything that's going on. Let's see. Not seeing anything too interesting over here. Trying to look for some macro news that could be relevant, but I'm not seeing anything. And that's the real thing too, right? When we're doing these things in real time, you really gotta, take time just going through articles, going through headlines. Now you're seeing all this inflation stuff. Maybe you might go and say, hey, what companies are going to go? What companies are going to benefit from inflation, right? And you could like literally just come and type that in. What stocks benefit from inflation?
And while you're looking this up, I just want to make sure it's clear for me and I guess anyone else listening in. Summation, what you're saying is figure out whatever your investment thesis is, bump that up into the stock screener. Once you have the stock screener, you're going to have, whatever the amount of companies there are. And then a good way to kind of filter through those companies is doing some additional research where you're going to be, I guess, Googling, checking the news and seeing, okay, do any of these industries or any of these companies actually, validate what I'm seeing in the stock screener. And then from there, you're kind of, just cherry picking. I like this company because I seen this pop up on ESPN. I seen this pop up on news.com, whatever.
Yeah.
And
So yes and no. I guess right now what I'm doing is showing you how to just go to a news website and generate ideas just from that. But on the latter, like, if you are researching the company using a stock screener, you should, if you come up on this stock screener, right, Autodesk came up, you could just go on here and type in ADSK, right, and see what kind of news is on Autodesk and stuff like that. So you should leverage the news and seeing what's going on. But yeah, there's I guess what I'm trying to get at is there's multiple ways to getting to an idea, to finding an investment idea. And I think it's just to have all approaches, right? You sometimes use a stock screener. You guys should regularly be reading the financial news anyway. And if something interesting comes up on financial news, you dig deeper into the story or into those companies, things like that. And yeah, and then, there's also groupthink, right? Talking to other people about what they're looking at, what they're trading. And that's not to just go and blindly buy things, but you might hear what someone's looking at, how we talk about cryptos. I'm not a crypto expert, but you might recommend me a crypto, and then I'll just go and investigate that, and if it checks out, then I'll buy it, So I just think there's multiple ways to generate ideas, and I think we should be using all those ways, because you just never know what's going to come your way, and you never know where a good idea is going to come from.
All right, sounds good. And sorry to take you off track too, but figure let me
ask.
No,
honestly, this was good, because I think people need this, right? How do I generate ideas? And that's very important. So now let's just get back to Meta. All right, so we have that. Sorry, I just got this thing blocking my screen. It's so annoying. All right, so now we're just going to go through each section. So just to recap, just bring it back over here, right? I think some of the most important sections before you dive deeper into a company is the business section of the business overview, management's discussion and analysis. That's super important. And then financial statements and supplementary data. If you feel like those areas check out in your mind when you're investigating a company, however you got to this company, then I would say dive deeper into the stocks. But if not, then, don't waste your time any further. I'm glad to see, you might have to go through 30, 40, 50 companies before you find a good one, right? So here's Facebook's business section, the business overview, right? And they talk about the different platforms, right? They have Facebook, they have Instagram, they have Facebook Messenger, they have WhatsApp, and then this is their virtual reality stuff. They talk about their competition. So who are they competing against? They talk about their technology, their sales and operations, marketing, intellectual property, government regulation. This is actually becoming very big for Facebook. So, that's something to be aware of, and not just Facebook, but social media companies in general, right? This is just a lot of heat coming down on them. Talk about human capital, diversity and inclusion, compensation, and right, and then now that's that, right? So you might go and take that look at that section if everything looks okay. Now you jump back. Now you want to come to management's discussion, and it's just, I think this is one of the most important parts to hear what management has to say and what management's outlook is going to be, right? So some of the data that they're giving us here is their community growth, right? So we're seeing daily active users, monthly active users, daily active people, and what that looks like. That's good. They're giving us all their financial results right here. That's good, right? What those growth metrics are looking at. We're talking about COVID and how they've been impacted. Now they're giving us trends. Let's see. This is actually interesting, right? Trends in monetization by Facebook user geography, right? So what places in the world is generating revenue? And they have it broken down worldwide, US and Canada, Europe, Asia Pacific, and the rest of the world. That's cool. And I'm obviously not sitting down and reading everything just because that's going to take too much time. But you guys can see the breadth of information that's here available for you to help you make a very informed investment decision. Let's see if anything else comes up. There's another interesting point, average revenue per person. This is accounting policies. You maybe don't have to get too deep into that. Let's see. Okay, components of results from operations. So now they're talking about their results of operations, right? Revenue, how they're generating revenue, where it came from. And then, now they're giving us, their actual documents, but I think they're going to talk about those documents. Perfect, right? So now they're talking about the ads delivered and what happened. What else are they talking about? They're talking about cost of revenue and where are the costs coming from. They're talking about research and development, right? So you're just getting so much information here that you're not finding anywhere else. You just got to come to the source directly. And that's the annual report and the quarterly report. So let's assume now, I just don't want to be too redundant and just scroll into the whole section. I think you guys understand that. And then I could come here, right? And now you could go to look at the financial statements. And we will have a session on financial statements, so don't you worry, guys. Right, and now you can see the growth of Facebook over the past 3 years, right? They went from 55 billion in revenues to doing almost 85 billion in revenues. It's actually pretty good growth, right? And now we have a breakdown of the cost of revenue, research and development, marketing and sales. That's fine. We can see the net income growth. Right, they went from 22 billion to 18 billion to now back to 29 billion, right? And now we're looking at this, right? They've had clear top line revenue growth. They've had, I guess this isn't clear growth, right? Because somewhere in here, maybe there was a really big expense for the year 2019, right? But you peep that as you're looking at it, what happened in 2019 that this company had this dip, even though they had revenue growth. And I'm going to have my investigative hat on. And income from operations, right? So I want to say, make note of this, right? Maybe you guys have heard, or maybe you have not heard, right? But when it comes to net income and earnings per share, companies can use a lot of accounting tricks to make themselves look profitable. Through depreciation, amortization, maybe there are certain taxes that were paid that made things a bigger loss than it should have been. There's all kind of financial tricks that they can use to inflate earnings per share. Even things like taking more shares off the market, right? That doesn't really change profitability, but if there's less shares available in the market, like them buying back shares, that will inflate earnings per share. So there's all kind of tricks that these companies use. So I want to say, income from operations is probably one of the purest looks at this a company's profitability, right? What's their revenues? What's their expenses? And are they profitable just based purely on that? You'll find companies with financial trickery. Their income from operations were not profitable, but somehow when you get down to the net income line, they were profitable, and that's a real thing. So just something to make note of. So, income from operations, something you want to look at closely. Of course, you still want to look at net income, but just say take net income sometimes with a grain of salt. So that's that.
I have a question about that.
Yes.
And this probably is going to sound really silly, but most of the people that are looking at the income statements and these financial documents are relatively sophisticated. So why would a company try to fool investors by using those accounting tricks when the people who are looking at the documents can see through it?
That is a really great question. And I want to say that you might think that these people are sophisticated, but you'll be surprised how many people are working on Wall Street that does not read a 10K or a 10Q. You see the kind of trading activity amongst your peers and stuff like that. How many people do you know that actually takes the time and even reads an annual report? Most people are not reading these documents. And with the accounting tricks, they know how to hide it very well. Like, for example, right, when we're reading this annual report, right now we're looking at a consolidated statement. So we're not even really seeing all the income stuff that goes between, income from operations down to the net income. We're only seeing 3 lines, right? So we don't really know what's happening here. And that doesn't mean that there is something happening here. And maybe I got to find a company that's a good example of that. But there's definitely ways to inflate your earnings per share, and there's ways to inflate your balance sheet. And if you're don't have deep accounting knowledge, you're probably not going to pick up on them. Like, for example, one of the tricks that companies use is using goodwill as an asset. So let's just look up the definition of goodwill. And that's actually a really good question, Andrea. Right. All right. So goodwill is an intangible asset that is associated with the purchase of one company by another. Specifically, goodwill is the portion of the purchase price that is higher than the sum of the net fair value of the assets purchased in the acquisition and liabilities assumed in the process. So this is already like a tricky thing, right? And like you might see a company, let's say they have like $50 billion in assets, and they'll say like $20 billion of that is goodwill, and that's nothing tangible. That's no piece of property. That's not cash. That's nothing. And you'll sometimes see companies reporting this $10 billion in goodwill every year, right? And if you don't really understand accounting, you'll just be looking at this company having $50 billion in assets. That's like, oh wow, like they have a lot of assets, but then you actually tear it back a little bit, and they really only have 30 billion in assets. And maybe it's a situation where they're reporting 50 billion in assets, and maybe they have 30 billion in liabilities, right? You take away that 20 billion from the goodwill. Now the company, does not have more assets than they have liabilities. And like you see, like the financial trickery, right? If you're not really well educated in accounting, like, they can get over on you. And then like the share buyback stuff, right? Some people are looking at earnings per share growth, right? And that's fine. And you might have your net income, but if you bought back shares, that's going to inflate your earnings per share growth and stuff like that. So there's just all kind of ways that they're able to do these things. And if you're not well versed in accounting, you're not going to pick up on it. So the smart people who are really well versed, of course, these things aren't going to get by them. But I would say most people at large, including the professionals who work in the industry, are not well versed in accounting and aren't even reading the annual reports.
It's interesting. A lot of times we're taught to look at the year-over-year growth or whatever, and not drill down. So I can see how maybe somebody who's just looking at percentage growth year-over-year and not looking at how that growth was achieved can be tricked. That makes sense. It would be great to have a running document, not for you to do a dump from your head, but as we come up with these things over time, just have running document of these like red flags to look out for.
It's actually a really good point. And when I'm prepping for our accounting sessions, I will make sure I do that, right? What are some accounting red flags? And you have one now, right? Inflating assets through goodwill. That's definitely like an accounting red flag. And that doesn't mean the company's doing anything illegal. It just means the company is not who they say they are. Another one is inflating earnings per share through stock buybacks. The earnings per share really isn't growing at the rate we think it is. It's just being inflated through them taking shares off the market, not that they're really earning more income. All right, now we're going on to the balance sheet. Actually, before I go on to the balance sheet, did that kind of answer your question, or you had any other thoughts, Andrea?
No, that was great. Thank you.
Okay, perfect.
Hey, Jeff, I have a question. Just, you don't have to elaborate on it now, maybe something for another time, but when you talk about the share buybacks, I just want to make sure I understand how that actually helps the company, because to me, it's like they're buying it back, so there's a cost for that. So I think that will be a cost to the company, but it actually seems like it may be a positive. So
yes. All right. So there's a couple things going on, right? First and foremost, fundamental dynamic of the market. And I'm going to ask you this question, Risharda. What ultimately drives a stock price, up or down?
Demand. Oh, that was not for me. Sorry.
Thank you. Oh. Got another answer.
Okay. Yes, but demand, but more than demand, right? Ultimately, the act of buying and selling, right? So if you are buying shares, that's going to help pump up your price, right? So like, you might see a company like Apple. I remember they did this a couple of years ago, like maybe 2018. Like they literally went out and bought like $500 million worth of their own shares, right? And then you're seeing Apple stock just keep going up, going up, going up, and that's why, right? Because they're buying so much of their own company. So that's one, right? It pumps their stock price up. So even though they're spending money on doing it, right, it kind of pays off because, like, if the stock price goes from $100 to $150, the overall value of the company increased 50% without you having to do anything but buy back your own shares, right? And then there's also an element of like these people are playing a rich man's game, right? So you don't need to have cash, right? If you have this asset, which is a stock that is inflating in price, you could go out and get loans against that. You can go and use that for collateral. You can go and use that for compensation for other people, right? So maybe they spent some cash to do it, but the payoff from doing it is a lot greater than the spend. Does that make sense?
It does. I'm going to do some more research on this topic because I know it was a company this week where their stock price, or like the percentage, went up by 11%, and that's just what they did. They had bought back the shares, and so I guess I was struggling with it is because we're saying buying back. So I'm thinking these are already existing shares that are out there. So I'm like, well, what's really the difference? It's kind of not like something new, right? It's existing shares. So
yeah, no, it's existing shares, and they buy it back. When they buy it back, it pumps the stock price up, and then also earnings per share is let's look up the definition of earnings per share, correct? Because I'm sure you guys hear about that a lot. Earnings per share formula. All right, so earnings per share, can you guys see this okay? Maybe I should zoom in a little bit. Earnings per share is net income minus preferred dividends. So that's just stuff that's being paid out, divided by common shares outstanding, right? So let's see if they give us a tangible example. All right, so you see this company right here, Ford, right? They have $7.6 billion in net income. They have 3.9 billion in common shares outstanding, right? So now if you do that 7.6 divided by that 3.98, you have that 1.91. So now let's say they bought back 1 billion of their own shares, and now they only have 2.98 billion. I'm just going to do the math real quick. 7.6 divided by 2.9. Now their earnings per share is 2.62. $2.62 per share. So you see, like that's roughly like a 50 or 60% jump in earnings per share just from buying back shares. Does that make sense, Rasharda?
It does. Thank you.
Yeah, so sometimes, once again, these are the games that people are playing, and yeah.
When you did your math for net income, did you minus $1 billion off of net income?
Nope. Right, because all right, so that's a good question, right? You might think that them using cash to buy back shares affects net income, but the cash that they use to buy back shares is affected in the balance sheet, not in the income statement, right?
Okay, so it'll be under the liability line item or something.
Yes.
Like that. Okay, gotcha.
Yeah. So, right. So you see like the financial trickery that's going on, right? Logically, you would think that, okay, they had 7.6 billion and they used like $1 billion in cash to buy back more shares. Shouldn't their net income be less? But that is not a business expense. That change happens in the balance sheet. And so their net income stays the same and their cash position might be reduced, but now their earnings per share is inflated. And then investors are going to see like, oh, wow, they went from 1.91 to 2.62 billion in a quarter with flat revenue growth. There must be something great going on in the company, But if you're a little more sophisticated, you'll realize that, okay, if there's no revenue growth, but there's earnings per share growth, something is wrong. you know? So that's just another mental red flag. If someone is writing down the red flags. Okay. All right, cool. Any other questions on this topic? Okay. All right, we can move along. Let's just get back to, so I don't want to get into the stockholders equity document because this just gets to be a little complex. But this is, like you see, like they talk about share repurchases, share-based compensation, shares withheld. So there's just a lot of things, like, you know, like just all the activity they're doing with shares is in this document. I just don't want to get into this for now, though. Another very important document is cash flows from operating activities, cash flows from investing activities, and then cash flows from financing activities, right? And then what is the cash and cash equivalents at the end of the period? So one of the things that I like the most is cash flow from operating activities. You guys maybe heard of the term free cash flow, right? And this is what they're talking about. From their operations, and then when you see this right here, changes in assets and liabilities, did this company actually generate cash, right? And I think this is a very important line item. And sometimes you might see, once again, through financial trickery, a company be profitable, right? But then you come here to their cash flows, and then you'll see like their net cash from operating activities is negative, right? And then you're like what's going on that the company is profitable, but the cash flow is negative, right? So that's another red flag. Or just sometimes, you know, something to investigate. And when we say red flags, it's not that they're doing anything illegal. They're doing things that's completely legal. You know, they just it's just things that you gotta say to yourself, I gotta investigate this further and see what's going on in the books. Cash flow from investing activities, right? You want to see if the company is making investments. And right, when we're talking about companies making investments, we're not talking about like investing in stocks and cryptos and stuff like that, which it can be because they have purchases of marketable securities. But a lot of times we're talking about property and equipment, and just whatever goes, you know, companies investing into other companies, companies acquiring other companies, right? They do all these activities. You know, did it provide profitable cash flow from investing? You know. But a lot of times this thing is expensive. This doesn't need to be positive. But if the cash flow from investing activities is positive, I think that's actually a very good sign. That means they're making investments that are paying off rather quickly. I think that's always interesting. Then there's cash flow from financing activities, right? So repurchasing their own stock, principal payments on, you know, debt, net changes in cash pooling entities. Actually, I never heard of this. I maybe gotta look up what this is. And that's another thing too, right? You'll go through these documents and then you'll hear these strange terms and just go and look them up so you can educate yourself, right? And then was there a positive change from financing activities, right? So issuing stock, buying back stock, issuing debt, paying off debt, whatever the case might be. These are all under the realm of financing activities. And then you get down here, right? And then what is the cash, you know, what is the company's cash position at the end of the period, right? And then you always want to see this to be positive. And you actually want to see that this is growing. I mean, I don't think that growing cash is a big deal. You know, I shouldn't say you want to see that it's growing. I think it's to just investigate where the cash is going, right? And cash flow, like this cash statement of cash flows, really just give you some insight into where cash is going. And like, hey, if cash is down because they're doing some more investing or they're doing some financing of themselves, I think that's okay, right? And it's just about what kind of acquisitions are they making or whatever. Like, for example, cash flows from investing activities, right? I remember a couple of years ago, Facebook bought Instagram and Facebook bought WhatsApp, right? So that would have fell under purchase of equity investments, right? You might see cash down because they made those investments, but I would say that, hey, if that's what they're spending their money on, I don't think that's a bad investment, you know? So I think it's just to investigate where the cash is going, and, you know, if they're doing investments, if they're doing share repurchases or whatever, just investigating what those investments are and stuff like that. Anybody have any questions? Yep.
I have a comment, I guess, and let me know if I'm thinking correctly. When you're looking at cash flow from operating activities, you basically want to know, Like, is your business model profitable, right? Because companies you can increase your cash position by taking out a loan.
Yep.
And your product or your service can be trash. So it could be looking like, it's not that customers, that your product or service is resonating with customers. It's that you're increasing your cash position by, financing activities or stuff like that. Right?
Yeah. No, that's completely true, and that's why, like, for me on this, like, net cash from operating activities is one of the most important things, because that's just purely based on your operation, your revenue, your income, and changes in assets and liabilities. Are you profitable, right? And it's not all changes in assets and liabilities, right? Peep that it's accounts receivables, it's accounts payable, partners payable, accrued expenses, deferred revenue. So it's not all, like, you're not seeing real estate on here. You're not seeing, obviously real estate will be more in the investing activity. I just want to point out, though, that it's not all assets and liabilities, but it's the changes in assets and liabilities as it relates to running your operation, right? So, like, accounts receivable. Does anyone know what accounts receivables is? And we will cover these topics or these line items when we have the accounting session, but I'm just curious, does anyone know what that is?
Kind of like when a company is going to get payments from customers, but they haven't paid in cash yet.
Exactly, right? So a company provided a service that they didn't get paid for yet, and they're going to be getting paid at some point in the future. Or maybe they didn't even provide the service yet, right? Maybe they agreed to provide a service and they didn't get paid for it yet, right? But whatever it is, it's money that's going to be received in the future. And make note of that, right? That is not reported on the income statement. Accounts receivable comes up on the balance sheet, right? So you see things that's related to your operation is sometimes not being recorded in the income statement, but these things are being recorded on the balance sheet. So that's why I pay very close attention to this net cash provided by operating activities. And Andrea, the point that you made is a very good point. And that's the purpose, right, of just investigating where the money is going or where the money is coming from, right? And is stuff truly coming from sales, or is stuff coming from financial trickery? Yeah, these people are full of financial tricks. Thank you for that, Andrea. Let's see if there's, all right, so there's some things here, right? If you're investigating a company further, then I would say only start reading this stuff if you are, one, going to be a long-term investor in the company. And secondly, right, if you went through those first sections, and I'm just, not to be redundant, but I just want to keep reiterating it so you guys don't forget, right? If you went through the business section, you went through management's discussion, and you went through financial statements, and things look interesting to you, and you think that, hey, this is a worthwhile investment, then you start reading, let me go to that page, right? Because they talk about how they recognize revenue and stuff like that, because that's also important to know how a company recognizes revenue, how a company is expensing things. Is it cash accounting method? Is it accrual accounting method? And we'll get into those things. Don't have to worry about that if you don't know these terms. But yeah, like how this revenue is recognized, right? What is advertising revenue, and how are they counting that? I think that's sometimes very important. What is deferred revenues, etc. So that is the income statement. Not the income statement. That is the annual report. So before I move on to the quarterly report, any questions or thoughts?
Yeah, Jeff, I have a question. Is there anywhere on any of the reports where, like, a company has to kind of report if they get like a major fine or some sort of lawsuit? Just because I remember, like, a few years ago, Facebook had like that data breach, and I think they were fined by the FTC. And then ever since then, we just keep hearing about new things that they're being fined or sued for.
Yep.
So is there anywhere where they would have to report that amount, or is that completely separate from like the income statement or the balance sheets?
Nope. You see right here, legal proceedings. You come here, and just like you just stated, right, the opening line, beginning on March 20th, 2018, multiple putative, I don't know what putative means, class actions and derivative actions are filed in state and federal courts. So they kind of get into that over here. And so it's not looking super detailed on the cases, but then I think you could take what they're talking about in here and just do a Google search and try to find more data on those cases. You also will be able to find news in their press releases as it relates to these things too. But yeah, so you would have to what you call it? Go to the legal section of legal proceedings section of the annual report. See what these legal proceedings are. You see they're talking about stuff all the way back to 2015. So I guess these are still ongoing things. And then you'll just have to really investigate, investigate those cases, right? Like here is a they're getting sued for I guess they have a facial recognition feature that violates, this Biometric Information Privacy Act, so I don't know. They got all kind of stuff going on. And you'll just have to see what's in here and then research further. Yep.
Okay.
Yep. Yep. Good question. It actually was a really good question. Because for some companies, right, this legal stuff, if you're not on top of it, the legal stuff, you might just wake up one day, randomly they lost a lawsuit, and then you see your stock is down like 60%. You're like, what the hell just happened? That was a really good question, Mariah, and that's something good to be aware of. Are there any legal things going on with this company?
Thank you.
Yep. All right, let's go back to over here. So we got quarterly reports. So now when it relates to quarterly reports, I would say, they have their earnings released, and then they have their actual Form 10Q. I like to go to the earnings release first, right? If I go to the earnings release and I don't see impressive revenue growth, I'm not seeing impressive, in this case, like these kind of metrics, daily active users, monthly active users. And then the thing that I'm looking for the most is the outlook for the company. If there's not a good outlook on the company, then I'm not even investigating the company any further, So I just want to say, when you're going through the quarterly reports, just take a look at the press releases. And, if you're not seeing some good growth metrics, or you're not seeing a good positive outlook on the company, if the company is expecting to do bad next year, then maybe it's not a stock to buy, and you don't really need to waste your time going to the annual report and the quarterly report. And then what you also can do is, where is it? I got to go back to the financials. Luckily over here, they have it pretty well organized, right? But then if you actually go and look at the press releases for the last couple of quarters simultaneously, right, it actually starts to paint a pretty clear picture of what's going on in the company, where you can just kind of skim through this data point. And before you even look at the annual report or look at the quarterly report, you can kind of make a judgment in your mind, right? If their earnings releases are looking, every quarter is looking bad, or every quarter is not giving good revenue growth, every quarter they're not raising guidance. Have you guys ever heard of the term raising guidance or lowering guidance? Maybe not. Okay. So raising guidance pretty much means when the company states that they are going to have a higher sales projection or a higher profitability projection than what is currently stated, right? So a company, let's say in Q1, they said, hey, we're expecting to do $1 billion in sales for the year. But then by Q3, they're saying, hey, we're actually expecting to do $1.3 billion in sales for the year, right? That's like what you could call raising guidance. And then the flip side of that is lowering guidance, right? So when you're seeing, that's just some, let's say, green flags, right? If you're seeing sales growth and guidance being raised, it's actually a very positive sign. And so, yeah, right. So I just say skim through the earnings releases before you investigate the companies. That just helps you save time. And I think time management is very important because, you just don't want to spend so much time on garbage companies. So now we have the Form 10Q, and that's the quarterly report.
Quick question, Jeff.
Yep.
So to your point here about avoiding wasting your time looking at companies that may or may not be worth the research time, would you potentially get or review those numbers like on maybe like a Yahoo Finance or CNBC, where they kind of show you the quarter over quarter or the year over year? Would you kind of look at that first before even going to the company's website?
Potentially. It depends how I was generating ideas, right? Let's just go back to the stock screener. Let's say I was generating ideas through the stock screener, and I'm just gonna go through it again. Let's say I picked, I want a company that's growing more than 25% quarter over quarter, that's in the technology space. Let's see, and let's maybe say, where's operating margin, right? And they have a, let's say, operating margins over 10%. Now we're down to 74 companies, right? This is already a list of high sales growth companies. So I'm not going to reference like CNBC and Apple. I mean, not CNBC and Apple, CNBC and Yahoo Finance, just because I already screened for high sales growth. All these companies are going to have high sales growth. And then all these companies have positive operating margins. So then I'm just going to go and just dive right in, right? But then something that I might do is, well, I guess that's just my process, right? Since I'm already screening for high sales growth, I'm not going to reference those things. But those are still good data points, right? And let's just go to CNBC.com. This is a good question, right? And I also want to say, fundamentally, myself personally, I like to go straight to the source kind of investor. I don't want other people's opinions. I want to see the data myself. I want to see the earnings growth myself, because I don't trust people's opinions. But let's see what they have for us here. But this is some good data. Let me zoom in a little bit. So they give you some earnings trends, and I think that's useful, right, to see like what's going on. I'm actually glad they have this already set up for us, right? You see how Facebook has a PE of 23. You see their industry, the average PE is 33, and then the technology sector is 42, right? So you could technically say that Facebook, as a high growth company, is trading at a discount to its industry on a PE basis. So yeah, I guess you could come to these different websites to get data. So let me not say, me and my process, I'm not using these things because I just go I'm straight to the source. But you can absolutely leverage these different tools to get different kinds of data. I don't want to tell you guys to not use it, because the more data, the better. Just so we see this thing about inside ownership and insider holdings, insider trends. Mariah, you asked that really good question the other day about insider trading, and just want to just talk about that real quick. Right, so an insider is a person who owns 5% or more of a company, or like an executive of a company, or just someone who maybe has material information, right? So for example, somebody who works on the VR AR team, right? They may not be an executive, right? But since metaverse is so big and important, that person is privy to inside information, right? And so on the legal tip, insiders are not legally allowed to share material non-public information with other people, so they can go to jail for that, right? And then us as people who are not insiders, we're not allowed to buy or sell stocks based on non-material public inside information. Material non-public inside information. That's the rules around that, right? So if you're an insider, you have to report whenever you are buying or selling shares, right? And that also is another good data point. And I say this isn't something that makes you want to say, like, I'm going to buy a company or sell a company based on insiders buying or selling. But it does make me say that, hey, if insiders are buying at a very high rate, there might be something going on in the company that we don't know about. And, or the insiders have a lot more confidence in the company than maybe we're aware of for whatever reasons, So I think that's just something that you just take with a grain of salt and say this can add to a thesis or take away from a thesis. So I know that we're venturing off a little bit, but I just wanted to bring up this topic of insider holdings and insider trends, because I think that's useful. And then there's also institutional ownership, right? Like we're seeing here, like this company, they own 62 billion. Is that correct? Wow. They own like $62 billion worth of the company, and they raised increased their holdings by 10%. You know, that's a pretty big buyer. And they own almost 10% of the company, right? Excuse me. So this is just another good data point to look at when you're researching companies. So yeah, I know I went off on a little bit of a tangent. Did that answer your question?
Yes, it does. Thank you.
Yeah, you got it. Perfect. All right, let's go back to the quarterly report. Okay, so the quarterly report is, as you can see, is structured a little different. You see this table of contents, and this is the standard table of contents for a domestic US company, right? International companies, they have I forgot the form names, but they're not filing a 10Q for the quarterly reports, a different quarterly report. So different companies from different countries listing in the US, they don't follow the same format, you know, but ultimately they still do have the same information. So, you know, you want to look at financial statements. For me, it's financial statements, and then it's management's discussion of what happened in that quarter. You know, I'm going to read these two things first. And we don't really need to go through this as in detail as we just did with the other one, because, you know, it's kind of the same thing, right? But except of it being data for the full year, now this is just quarterly data, you know, and that's fine. And then let's just jump to the management discussion section. Right, and you know, once again, it's giving you that data, executive overview of the third quarter. You know, they're giving you all kind of data, financial results, community growth, what happened with COVID, user metrics, etc. So we don't got to really go through all this again, right? But this is all the same data, but just now really based on what happened for the quarter. And once again, right, if the financial statements aren't checking out for me, and management's discussion of what happened isn't checking out for me, then I really don't need to spend any more time on this company, because, you know, you just really, I just think time management is just too important. So that's that. I want to jump over to a different, actually, no, we can stay on this company. So we went through the annual reports, the quarterly reports, right? And a lot of that was quantitative data sets, right? But now let's talk about qualitative data sets. So let's go back to meta.com. Right, so now another thing that I'll be doing, right, is just really going through the company and understanding who they are. Right, they have the logos of all the companies that is in their universe. They're talking about what the metaverse is, they're talking about virtual reality, augmented reality, right? So what I'm getting at here is investigating a company's products, right? So I feel like because Facebook is structured the way it is, like, you know, they're not making it as clear, you know, what their products are and stuff like that, you know, on this website, right? But you want to go through their products. This is some of their hardware. I don't see them talking anything about WhatsApp and Instagram. All right, so I guess they have it down here, right? And you could click this, and, you know, you can investigate what is Messenger and what does Messenger provide. And I just think, like, product research is just so important, right? Like, if you don't believe in the product, you don't think the product is good, you don't see the market for the product, then it's maybe not a company to invest in, you know? Or if you're seeing great growth metrics or great stuff in the books, but the products aren't adding up for you, like, as in, like, you don't understand why people are buying this, and it's maybe just to talk to other people and see why other people like it and get consensus from, like, you know, the real world. So I just want to say, like, product research is, like, very important, and you want to investigate that. Some other areas that you want to investigate, and I mean, I think these are a little tougher, but it does take some digging. But, like, you know, how is this company marketing themselves? You who is their target market? How big is the market that they're going after, right? These are some of the questions that you want to ask, that you want to get answers to, right? Sometimes you might see a situation where, hey, a company's been, having like 20, 30, 50% growth over the last like 7 years, 10 years. But now like they literally own like 90% of the market and there's no more room for growth, right? Maybe if a company's at that standpoint, looking in hindsight, they had great growth metrics, but looking forward, if they own 90% of the market, there's no more growth for the company unless they create a new product or service that they can go after other markets. So I just want to say, right, you don't want to just go through the annual and quarterly reports, which are very important and to get very important data, but you also want to investigate, the product, the services, what are customers saying about this company, what are the customer reviews? We live in a time where there's so much review data available, so you can see what people are saying about the company. So for me, as a rule of thumb, if I look at like customer reviews and customer feedback, and I'm not really seeing people loving the company and loving the service and loving the experience they're getting, I don't feel comfortable being a long-term investor in that company. It could be a good short-term trade, and that's fine. But it's about from a long-term perspective. I want companies that people love the products and companies that take care of their customers and take care of their people. Because I think humans are, is what drives revenue growth, right? People loving your stuff. What are some other areas? And then there's like competitive analysis, right? So just understanding, and let's just break it down by steps, right? Of course, you're going to have your methodology for how you got to a stock idea. Then you have yourself investigating the company, looking at the quarterly reports, looking at the press releases, looking at the 10Ks and 10Qs, assuming the company checks out and you want to move forward. Then you want to move on to doing competitive analysis, and then you want to see who are their competitors, and you actually want to do the same thing, right? You want to go through the competitors' books, you want to go through the competitors' annual reports and what are their products and services, and hey, who has the better product or service? Which product or service, which company has a better customer base, things like that, right? So you also got to throw in that competitive analysis. And I know this gets to be very intricate, but that's the whole point of also just being efficient with your time, right? Like if a company is a garbage company, you do not need to be doing competitive analysis on a garbage company, Also, through doing the competitive analysis region, this has definitely happened to me in the past. You might be researching a company's competitors. You thought one company was great, and you realize that their competitor is far superior, and the competitor is the better investing option. So competitive analysis is important too, right? So just to recap, you want to look at quantitative factors, right? Like the annual report, like the quarterly reports, and all those good things. We want to look at the qualitative factors like product and service, product or services, meaning from a revenue standpoint, customer support, customer service, brand loyalty, marketing strategy or business development strategy, community development, right? I think community development is a bit of a new term and a new thing that people are doing these days with building businesses. But, companies that are really good at building community are probably going to thrive more than the companies who cannot build community. And then those are some of the things that you really want to investigate when investigating a company. So with that being said, any questions or thoughts?
I'm feeling really chatty today. I have another comment.
No, chat away, please.
One of the reasons the Wall Street organizes its analysts by industry sector is because of how much time it takes to research. So if you know an industry really well, and you're looking for new companies and you're looking through reports, you'll know those industry, I don't know what you call it, like averages and stuff like that. So you said, Facebook trades at a 20 multiple or something like that, but the industry is like 40 or 60, depending on what you reference. So do you think it makes sense to do something similar and maybe focus on an industry that you're interested in, and so that makes that research time a little bit more efficient?
Absolutely. And I guess since I'm experienced, I'm sometimes taking so many different approaches, right? I'm sometimes taking the stock screener approach, But like one area that I was investing very heavily in, or two areas, was e-commerce, right? So now I'm taking a purely industry approach. I'm looking at the solar industry. I'm looking at, like, the solar industry, like, data as a whole, like, what is the growth, what is the outlook, who are the largest players. I'm also getting the in terms of valuations, right? What is the average PE for the industry? What's the average price to sales for the industry, and all these other valuation metrics. And we will have a session on valuation metrics, so don't you guys worry. And then I'm doing that comparison, right? And seeing who has the best metrics and who has the best products and things like that. So absolutely, that's a fine approach. And some industries, I want to say, some people don't even realize that, right? Like, you could literally make a whole investment living and investment career off of one industry. Like, there's people who all they do is focus on retail, right? There's so many retail companies out there. There's some people who only focus on technology. There's so many technology companies out there. I know I gave a long-winded answer, but long story short, absolutely. You can pick an industry, hunker down on that, become an expert in that industry, and, take advantage of your domain knowledge in that space.
Yeah, I think what would be awesome, and I've said this before in other forums, but this is just my 2 cents. It gets really powerful when you have a bunch of people with a bunch of domain expertise. So, like, I don't know, there are 13 people on this call. If each of us specialized in 1 or 2 industries and then came together, that would be like between 13 and 26 industries covered. That would be like a really powerful research machine.
Yes, you're completely correct. And these are some of my, I'm glad you brought that up. That's like some of my longer term ambitions. And I know I've reached out to some of you guys to kind of work on research together, right? But, we're all becoming educated here, and we could kind of create our own little research powerhouse, and just about, if people are passionate about researching and really enjoy this game of researching companies and researching industries, we could absolutely do that, right? And I think groupthink is a very powerful thing. And groupthink is even more powerful when everyone is informed and educated and doing things the right way. So if obviously it starts with me as a teacher, if I can help get you guys to the point of, being really good investment researchers, and then you guys can turn around and apply that to where you have domain knowledge, I don't see why we couldn't do that as a group.
Yay.
Yeah, so that's what we're working towards, So I love that you're thinking that way, and I'm all about the group economics and the group think. So I think that about covers it for today. I know we covered a lot, but I guess before we wrapped up, anyone have any questions or thoughts? Nope. Okay. All right. So
Sorry, I just have a quick question.
Mm-hmm.
So, are there ever instances where you might think of investing in a company that doesn't have a great balance sheet at all, just simply for the reason where if it did have a good balance sheet, then its stock price would have been much higher than it already is? But there's other reasons for you to maybe somehow you have a friend at the company, or you have some other information that's not reflected on the balance sheets that let you have good conviction that it will turn out much better in the future.
Okay, before I answer that question, how are you defining not a good balance sheet? Are you saying like a debt
cash
company?
Sorry. Maybe some things like bad cash position, or a lot of debt, or just like declining revenues.
Okay, so I guess your question is beyond the balance sheet, but it's about the income statement and balance sheet and just financial statements in general, right? Would I invest in a company with poor financials? Probably not. For me to invest in a company with poor financials, if a company has like declining revenue growth and all those things, the company would have to maybe be a turnaround situation, right? The company has been doing horrible, but there's something that happened that's going to turn the company around. So if I'm in tune with the turnaround situation, then yes. But if a company's just a bad company and having, poor financial performance is just a reflection of, if there's customer demand for this company, right? If customers love your product, if customers are buying your products, it's going to reflect in your financial performance. So If it's not a turnaround situation, then no. I'm not going to be investing in a company that has, declining revenues and, because the stock price is only going to go down. Of course, there could be stock price manipulation and there might be a couple of days where the stock is pumped or whatever, but ultimately, especially if you're being a long-term investor, if a company just has, let's say, just overall this poor financial performance, that's going to be translated into the stock, and that's going to mean your stock's going to be lower. So I think the goal, right, should be, and you're asking a good question, the goal should be, how do I buy a company that is well ran, that people love their products and services, and well ran meaning like, they're managing their expenses well, they're managing their cash well, they're making the right kind of cash investments, right? You want to stay away from like trash, mediocre companies. Long story short, right? How do we identify companies that are, and a good example of that is Apple, right? For the longest time, like going back to like 2015, I remember like Apple was like a $700 billion company with like a 35% profit margin. At that point in time, like that was like completely unheard of for a company of that size, right? Because it's a very well-ran company, very well-capitalized company, and they have products that people are just buying off the shelves, right? Especially like 7 years ago, 10 years ago, every iPhone that drops, it gets sold out. And it's also, and this is the thing that I missed with Apple, I just think it was about phone sales. It's not about the phone sales. The phone sales is one thing. The real money is, and the real growth is in all the app downloads, right? Apple gets like 20 or 30% of every dollar that is spent in their app store, so you can only sell like a finite number of phones. You're only going to sell so many devices, right? But in this era of apps, right, the potential for like revenue growth through like apps and services is just like infinite, right? There's just been an explosion of apps in the app store. So yeah, that's my 2 cents. I know I'm going off on a tangent with the whole Apple thing, but I want quality, well-ran companies that are growing, that have great products and services. I don't want mediocre companies.
Definitely, yeah, that makes sense. And I get that. I guess you would look a lot at quantitative variables that would prove these turnarounds or any event that might make you invest.
Yeah, I think for a turnaround situation, it's going to be less about quantitative and it's going to be more about qualitative. For example, there was a couple years ago, like Denny's was doing horrible as a company, and there was a company that stepped in and bought them out and tried to do a turnaround situation with Denny's, and so it's not about you're not going to find any kind of numbers in the books that's going to tell you this turnaround is going to be a success, right? It's going to be, hey, is the person buying out Denny's, does this person have a track record of taking failing restaurant chains and making them successful? If the answer is yes, then that's a check, right? Normally, if a company is doing a turnaround situation, the company that is acquiring the bad company or whatever, they probably have some kind of game plan for how they're going to turn it around, right? And if their game plan doesn't make sense to you, or it's just like, I think this is bullshit and this isn't going to work, then that's probably not a check. But if it does, if it does make sense to you, you think like, oh, this is a great idea and this is a great new market they're going to tap into, or they're going to switch up their services, or whatever the case might be, And so I just want to say, like with the turnaround situations, it's more about qualitative, because there's nothing in the numbers that's going to tell you if it's going to be successful or not.
Yeah, for sure. Feels like a very individual analysis then, and there's no hard set criteria for what's going to be good qualities, and it's going to be based on each person's preferences.
Yes, and it's also on a case-by-case basis, and I even want to say with that Denny situation, so that the company who acquired Denny's, I don't remember all the details, but they actually had a track record of success with turning around restaurant chains. But with Denny's, they weren't able to successfully turn it around for whatever reason. So even that, right? All the qualitative factors might check out. This might look like a great buyer. The great buyer has great intentions, and it still doesn't pan out, and that's a very real thing. But that's the risk we take, right? I think Denny's was trading at like $3 a share at that time. If that turnaround situation had worked out, you might have been looking, we were buying Denny's at $3 for clients. I was actually pitching it like when I was working as a stockbroker. And, Denny's might have been trading at like $20 a share, with a good turnaround situation, but that it didn't pan out to be that way. So yeah, so that was a good question, and yeah, definitely like with turnarounds and stuff like that, that's definitely like on a case by case basis, and it's more qualitative and what's the game plan and who's buying it and what's the strategy, as opposed to what are the numbers, because the numbers cannot tell you anything.
Okay, got it. Thank you so much.
Yep. Okay, great. Anyone else have any questions or thoughts before we wrap it up?
Yes, I also have a question on the valuation of a company. I know there's different approaches. For example, you use the PE ratio, but sometimes they just say if they have a negative earning, but they have really good positive cash flow, how would you do a valuation on them?
Great question. That is usually the case for most technology companies. Okay, Denny's is 15 now. So I just want to say, right, when Denny's was $3, this was like 2012 or 2010. So I don't think we want to wait almost 10 years to get a 300% return. But thank you for that. I guess Denny's did work out. I don't know. But yeah, back to you, Liang. Your question, right? So that is the case for a lot of technology companies not being profitable. So there are other valuation metrics, right? One that I like to use is price to sales ratio, right? So rule of thumb, right, for most technology companies, companies are bought and sold in the private market, right? So not publicly traded companies, but like when these companies are private before they get listed, right? They're usually bought and sold at 10 times revenue, meaning that, hey, if a company is doing $100,000 in revenue, then an investor would buy you out for $1 million.
Mm-hmm.
So price to sales is a good metric. Just like you said, right? The operating cash, the operating margin is also another very important and good metric. And then sales growth and then projected sales growth is another good metric. So there's other valuation metrics other than PE. I guess I keep referencing PE because it's very common, and maybe you guys have your heads wrapped around that a little better. But yeah, I actually use price of sales more than I use PE, because PE isn't really forthtelling. Actually, let's take a quick look at this real quick. Let's just take a look at some valuation metrics that could be relevant, because that was a good question.
Because sometimes this is my professor's approach. He uses like the free cash flow, and then he project it to the future, and then divide by the outstanding shares. I guess I find that way makes sense for me sometimes.
Yeah,
but sometimes it doesn't work on all type of company.
Yeah, no, that's true. And I think it's relative to what kind of company you're looking at. Like PE is obviously relevant for profitable companies. PE is completely irrelevant for like small growing companies that are not profitable, right? So there's other metrics. Let me just zoom in. So like there's the price to book, there's the price to sales. Price to book this is interesting. Okay, that's fine. What you call it? So there's the book value per share. So I think we covered this the other day when we were talking about value investing. Book value is literally the assets minus liabilities, right? And what is the value of that per share, right? And then so they're saying Apple is trading at 44 times its book value, right? So there's price to book, there's sales, there's the PEG, price to earnings to growth rule of thumb. A company with a good PEG ratio would have a PEG ratio of 1 or lower. So yeah, if you have like a 0.9, a 0.8, a 0.7, like that's actually really good. That means once again, the company's growth metrics is expected to be higher than the company's current PE. So this is interesting, right? Apple is not expected to grow, doesn't have a good growth metric. They have a 15.6% earnings outlook kind of thing, but their PE is 30. But once again, right, these are, and this is the nice thing about these things, right? Because these are just another human being's projections, and a lot of times people are wrong, right? And sometimes people miss things, people don't see things in the business, people don't see where the growth is coming from, and you might have domain knowledge or just have a different perspective where you're like, hey, the market's completely wrong about this. I think that's where you can see some nice opportunities. Quick ratio and current ratio, that's another good one. So there's other valuation metrics that are not tied to profitability that can just help you tell you if this company is better than others. And I want to say there is no proper price to sales ratio or price to book ratio or anything. I think it's just more so relative to the industry, right? If the industry's price to sale ratio is like 100 and Apple's price to sales ratio is 7, then they're trading actually at a deep discount compared to their competitors. So yeah. I'm gonna put this LFMD stock real quick because they're another good example of this. So this is like a technology telehealth company that's growing at 100% a year, right? Literally, and they like you see sales quarter over quarter up 126%. They only have a price to sales ratio of 1.7.
Jeff, I don't know if you want to share your screen.
Oh my God, thank you.
I just noticed the way you were, explaining.
Yeah, I was just explaining all these things. You guys were not able to see anything. Okay, I'm sorry. Let me go back to Apple real quick because you guys didn't get to see this, right? So yeah, you have your price to sales ratio, price to book ratio, price to cash flow, price to free cash flow. There's all these metrics that's available to you. So PE is tied to earnings, right? So if you are not a profitable company, you will not have a positive PE, or you might see companies have no PE, right? And that's because they're not profitable. And that's actually a quick way to determine if a company is profitable without even looking. If they have a negative PE, then they're not profitable. So you have all these metrics, and I think when we have our session on valuation metrics and financial ratios, you guys will understand these things better. But just for now, just take that as a grain of salt, right? That these are just a bunch of valuation metrics that are not tied to profitability. So you can still find out, even if a company is not profitable, you can still compare and contrast, right? Is this company trading at a better valuation than their peers and their competitors? And then also, right, these valuations are changing all the time. Of course, sales and income is like stagnant, as in right? Like sales is only reported every quarter, right? But a stock can jump 100% before sales are even reported and stuff like that, right? So these things are fluctuating. And so like we're seeing in a market sell-off, right? These things are coming down, and that's always a good sign for good companies. When your companies are selling off, they're trading at better valuations. All right. Anybody else? Nope. Okay. So thank you all again, as always. Me and Raz are going to make sure that we get you guys all the recordings and all the decks. I'll make sure we'll just drop the decks in the from the previous calls in the Telegram, just to make that quick for them, Raz. But we'll send a follow-up email to the group with the videos and stuff like that once we have them edited and on YouTube. And yeah, so thank you all, as always, for just joining in on the call. Have a great weekend. Have a great holiday season. And have a great day. Thank you guys for taking the time, and we'll be in touch. Yeah.
Thanks, Jeff.
Thank you so much.
Thank you.
Bye.
Happy holidays.
Yes, happy holidays. Have a good one.
Thank you. Bye-bye.
Bye.